Mark, let's take a few minutes then to think about what we're seeing on these markets and discuss them. I mean, we saw different assets responding very differently to that inflation print out of the United States yesterday. Did that in any way make sense to you? Does it tell you anything about the way that the markets are thinking about and digesting this inflation data?
Anna, you're going to get me in trouble because this is just teeing up the different reactions between bond traders and equity traders. And I have a very clear bias in this issue about which one interprets data a little bit more intelligently. Look, I think fixed income traders, it is the macro community. It is the community that is most reliant on those macro data prints, and therefore they tend to react in a slightly more sensible fashion. Equities, and it's not entirely illogical, equities traders tend to be ultimately optimistic. And this is why stock markets tend to react a little bit later in the cycle to what happens to macro data, to what happens to rates pricing. So yes, we do have that misalignment. I know which one I believe. I think it's rates traders are realizing that rates are going to need to be higher for longer in the US. We are getting a steeper inversion because they're worried about what that means for growth. And whereas equities trades are still trying to hold on to this idea of immaculate disinflation and a wonderful soft landing world.
If we're learning a lot more about inflation, and you say we're moving on to thinking more about growth, is that going to be putting the short end or the longer ends of the yield curve in focus for you? I know both have been moving because of rate expectations and growth expectations, but where do you see the focus now?
Well, I think for the last few months, I think the most mispriced part of the curve is the front end of the curve. This idea of this crazy Fed pivot being priced in 2023, which was never going to happen unless growth absolutely collapsed. And there's been no sign of that collapse yet. And it's looking even farther away. So I think that, you know, we've seen much bigger adjustment on the front end, but I think the front end still has more to go. I think the front end's where we're going to really see significantly higher yields over the coming months. And as a result of that, I think actually we're going to get a deeper inversion because people are going to be worried about what that happens to the economy after a lag.
I was really interested in the Macroscope piece that our colleague Simon White put out that you drew my attention to, Mark, talking about cyclical domestic inflation still rising in the United States, whereas the acyclical or maybe internationally driven inflation was dropping. And that's very much, he says, tied to Chinese PPI, giving us a sense of maybe those lags that are built into Fed policy and how much of the Fed tightening cycle we may not have seen the impact of.
Yeah, I think that's right. I think, you know, this is kind of goes into the argument that inflation is going to continue to scare, and that it makes it more likely the Fed makes a mistake and makes it even more unlikely that a soft landing will ultimately be possible if we're going to bring this inflation under control.